Is this on? That good? All right. Hey, all right. So, good afternoon, everybody, and welcome to Knoxville Entrepreneur Center. My name is Jim Biggs, and I am the executive director here at KEC, and it is my distinct pleasure to welcome you both in person. Thank you guys for being here, and also virtually to those of you who are watching through digital pixels. We're excited to have you. You'll forgive me for reading, but I was told that I would lose all favor with the chamber if I went off script. So I'm going to aspire to keep this tight. We appreciate you joining us for the second of 3 events about angel investing. Many of you had the opportunity to attend our first event about what angel investing is. Today we're going to dive into the nuts and bolts and learn how to do it from a panel of local industry experts. Then we will hear from Knoxville residents and founders of successful startups that received angel funds and who later became angel investors themselves. After the second panel, we will leave plenty of time for questions. And so if you are online, please feel free to put your questions in the chat at any time. Before we begin, let me just tell you a little bit about KEC. And then I'll also tell you a bit about the other co-hosts, the Innovate 6.5 Alliance and the Knoxville Chamber. At Knoxville Entrepreneur Center, we are changing lives through entrepreneurship. Our vision is to create the most founder-friendly city in America. And to do that, we are building an entrepreneurial community that is accessible, that is diverse, and that is sustainable. And we are excited to be able to welcome you guys into that community. Whether you are a food truck entrepreneur or a tech startup, KEC helps makers and innovators with classes, events, resources, and connections. The Innovate 6.5 Alliance is a coalition that develops, supports, and promotes Knoxville as a great place for entrepreneurs to start and grow a business. Founding members include Oak Ridge National Lab, the University of Tennessee Research Foundation, UT Research Park, TVA, the City of Knoxville, Launch Tennessee, Three Roots Capital, Veteran Ventures, PYA, KEC, UT's Anderson Center, and the Knoxville Chamber. And finally, guided by its 5-year strategic vision, Path to Prosperity, the Knoxville Chamber is an economic prosperity organization committed to its mission of driving regional economic prosperity. So why are we here? There isn't a community on earth, save maybe Silicon Valley, that thinks it has enough capital. And to some extent that's true. It is, I would suggest, possibly uniquely true in Knoxville. And we have struggled to get some of our best companies funded here. And as a consequence, some of them have not been able to stay here. We need to make that happen. We need to change the dynamic. And so this is a conversation about how we pull more folks off the sidelines and get them into the angel investing pool. Yes, Nancy, I'm winging it. Sorry. That became very apparent in a white paper that was written for the Knoxville Chamber entitled Capital Access Redefined. And it highlighted the need for more capital here and described Knoxville's community of angel investors and why they are key to keeping businesses here and attracting companies to our region. And so it is my pleasure to introduce the researcher and the consultant who wrote and authored that white paper, Richard DePauw. Richard is an executive in residence at KEC. He is also a member of our board of directors. A transplant from New York, he is also a venture advisor for MBX Capital. And Richard is going to be the moderator for the panel today. And Richard, I'm just going to turn it over to you and let you introduce the panel, if that's okay.
Okay, and so we've Grady Vanderhoeven. If you want to take a few moments to give the folks a little bit of your background.
Founder and the president of Three Roots Capital, which is a community development financial institution. We make loans and equity investments in companies and projects throughout East Tennessee and the broader central and southern Appalachian region. We've raised about $108 million. We've deployed about $75 million. And historically, I've been involved in venture capital in this region for about the past 20 years.
Thanks, Richard. Thanks, Grady. I'm Scott Ewing. I'm a co-founder and the principal business analyst in the Appalachian Investors Alliance. We are a 501c3 nonprofit that organizes groups of accredited investors, as our name says, in Appalachia, but actually we work beyond that as well, so just call it generally in the heartland. Our purpose is to take a group of about 20 accredited investors or so in a community, investors that are interested in impact investing, help them create a small venture fund or what we call a micro venture fund, and then deploy their private capital into the community and the region for greater economic impact. Appalachian Investors Alliance then serves those funds with technical support, and that's principally my job. But to date, we've deployed about $20 million of private capital into Appalachia through 12 active funds that we support. And we have seen on top of our money, either afterwards or alongside, about $630 million additional dollars come in. So we're quite pleased with the leverage and the economic impact that we believe our investors are having. John?
Sure. My name is John Morris. I am a local entrepreneur. Been involved in multiple startups in the region. Some that have went fantastic, some that didn't go so well. But that's the history of, I think, every entrepreneur. But for this discussion, I am the co-founder and co-VP for the Lighthouse Fund, which is Knoxville's angel fund. We've had about a 7-year run. We're currently close to additional capital in, and we are reaping the benefits of the investments we've made over that 7-year run.
So my mic is on, right? You guys can hear me? Perfect. All right, so let's get right into the questions. Angel investing, what is it, and how do I become one? Grady, why don't you give us your view on that?
Well, I think the simplest way to become an angel investor is to find a company that you're interested in and make an investment. I think it's literally that simple. It's probably not the most effective way to be successful, but it's probably that simple.
Since I've got the microphone, I'll let Scott do it. So there's really 3 different ways to be an angel investor. One is to find a company and invest in it yourself, which requires that you find out whether the company is valid, whether you think it's going to make it. You know, you're making a bet solely on that one company. Another way is to get involved in what's called an angel group, and that is to get with other angels and vet those deals together and co-invest together. In that scenario, you don't put money up front, but you're investing in each deal, but with other people. And then the third way is through a fund, and a fund is a way to pool money. So you invest in the fund, and then that fund will invest in additional companies, usually with a team of people who does most of the due diligence and evaluation of the investment.
I could say something pithy like angel investing is when you would put the hope ahead of reason in your behavior. But really, to be a good angel investor, you have to reverse that. So if you want to be an angel investor, I think one of the things that you have to do is be terrifically self-aware. You have to understand your own predisposition, your own risk tolerance, your own biases, and then either work to reduce those biases. None of us can get rid of all of our biases. But as John said, you can surround yourself with other investors, other people in a group or a fund that complement you and that might be able to check your biases so that you get a more balanced, rational view of the investment opportunity. And then, as Grady said, find a company, right? So I think becoming self-aware, learning how to check your biases, and then finding the opportunity, perhaps in concert with other like-minded individuals, is a great way to be an angel investor.
I was going to just make the differentiation between what is an angel investor and what is an institutional investor. Because because I think it's an important differentiator. An institutional investor, if you think in terms of venture capital funds, private equity funds, hedge funds, pension funds, these are institutional investors. They invest. It's a company or an organization that invests money on behalf of its members or on behalf of the organization. An angel investor is investing his or her own money, and they're involved in the decision-making process themselves. So that's an angel investor as opposed to an institutional investor.
Thank you for that, Grady. So any thoughts on how is there a progression? Does one start as an angel investor and then become part of the institutional allocator community, or are those always separate lanes?
I don't think you don't just become an institutional investor. So you certainly have to have some experience. Now, I know Grady probably jumped right into that when he left the lab many years ago. But I think there is a progression. I think you have to have some understanding of investing. The angel investing is inherently different also from investing in the stock market. The stock market has some very well-defined metrics that you can determine, what to invest in. For instance, a PE ratio. So that actually tells you how much money the company is making and how much they project to make and all that. With startups, you can't do that. They're not making a profit. Most of them are not doing that. So you have to have other metrics that you evaluate with angel investing. I'll add one thing to the conversation before too, and that is that most angel investing is what I call, I know a guy, right? It's somebody comes to you and they say, hey, I got this deal. Let's go, I can, come, I'm going to invest in this deal. You come along with me and invest in this deal. I think that leads to a lot of failure. Sometimes it's very successful, but most of the time it leads to a lot of failure. If you want to be an angel investor, it's good to get active in angel investing. And that means that you've got to put forth the effort to get to know other angel investors, to work with other angel investors, to find out how you become more self-aware, as Scott said, in making that investment. Not just, hey, somebody said there's a deal here. So I think that's really important for this discussion.
And I'd tag on to what John just said about that. And having myself worked in 3 different parts of the industry, I've worked in public market investing, I've worked for venture capital funds, and I've worked in the angel investing sector. And I would say that neither of those, or none of those 3 is inherently more professional. There are people that are professionals in all of those, and there are people that are quite amateurish at all of those. So you can be professional and successful in all of those. You don't have to migrate from, say, the angel stage to the venture stage. You sort of tend to make a spot for yourself in the industry and generally focus there. But I don't think there's any reason for anyone to think one tier, if you want to look at it that way, is more professionalized than the others. But I do agree with what John said, that if you're going to work that tier, I think you ought to do everything possible to try to understand the nuances, I would say, and the particularities of that sector. Otherwise, you're going to be doing, what John said, the colloquial, working with somebody who says, hey, I know a deal. And that generally doesn't work out well.
Okay, that's helpful. So we've delineated between institutions and angels. We'll stick with angels for now because that's our overarching theme. So when does an angel investor get involved in the life cycle of a company? Is it when 2 people have an idea and it's on the back of a napkin, or is it after they've actually entered the market? When does an angel actually bring their personal balance sheet to bear to support the company?
I honestly don't know. These guys will have their own experiences and opinions. I don't know if there's a hard and fast rule about that, because I've been involved in companies where the very first investor in the company was an angel investor, right? And in some cases, it was a brother-in-law or a grandparent or a father of the founder. And in some cases, it was a very sophisticated, knowledgeable, experienced executive who became an investor in a company, but they were the first money in the company, the first external money, the first money from someone other than the founder. I've also been involved in companies where some very sophisticated angels came into the company after institutional investors were in, because they were very high value added individual investors. The retired COO of Verizon Wireless came in as an individual investor into a deal that we were in, and that company had already raised, $8 million by the time he came in. And it's because the other investors recognized this angel investor as a super high value added investor. So in my experience, angels can enter the company at a variety of different stages and phases in the evolution of the business.
Yes, I'll reclassify one thing Grady said. That first money, and generally a company will go through stages of investment. Seed stage is often it is the very first stage. That's usually when the company doesn't have a product. They don't have, they've just got an idea. They're just trying to get going. As Grady said, that's usually when an uncle or a cousin gets involved. We used to call that 3F money, friends, family, and fools. And then typically right after that is the early stage of investment. And that's when an angel investor will typically get involved before institutional capital. You'll then hear the phrase Series A. Series A is typically when institutional capital gets involved. But as Grady said, an angel can really be involved at any phase along that. Those stages classify the risk profile of the company. So the earlier you invest, the higher risk, but it's also the more return you get if it's successful. So I've always believed and seen that the return that you get on an investment is typically correlated to the risk you take. So the more risk you take, the more reward you get. But it also means that the more risk you take, the more times it fails. So as they grow through those stages of investment, they gain more revenue, they get traction in the marketplace, that risk profile goes down. So I think you have to understand as an angel investor, where do you want to participate from a risk perspective? Do you want to get in that early, or do you want to wait until a later stage when the risk profile is less?
Everyone I work with in my professional life is an angel investor by their own description. But angel investing, as you just heard, covers a pretty broad swath. There are people that really are at the seed stage or even friends and family stage doing what's technically angel investing. There are people that are in venture funds doing venture capital investing at the angel stage. So there's a rather large range. I happen to work kind of at the intersection of what would be called late stage angel and early stage venture. So typically what my investors that I work with are looking at is the performance on the capital that was invested with the previous round of angel investors. They generally, again, the people that I'm working with, want to look at that first angel investment and see how the entrepreneur was able to use that money and what they did with it, and then follow on at our stage with another angel investment, if you want to call it angel stage, to prepare it for the next round, which would be venture capital Series A, if that makes sense.
Okay. This brings to mind a question, maybe it's a little off script. So how should, if I'm the founder and I'm engaging an angel approaches me about supporting the company, how should that founding team or founder be thinking about the next round of funding and the hurdles and expectations of either the existing investor group if they come back in and or a seed investor if it's at that stage of the life cycle or the pre-Series A or the A? How should the founder be thinking about the money they're taking in now and the hurdles that they need to hit in order to unlock the next round?
Usually that's determined by the value of the company when the investor makes the investment. So what the entrepreneur has to do is to really understand what they're giving up to that angel investor at a really early stage, and what the next round might look like. You should, as an entrepreneur, you should have in your mind when you're taking on an investment what the next round is going to look like, because that round is going to determine whether this round has an upside or not. Okay. In some cases, people are looking at the round of angel investment as the next round may be an exit. Okay. You don't want that exit to be less than what they invested, right? You want it to be more. And the best way to do that is to always understand what the growth of the investment is through each round. There's no simple, give up 25% in the seed stage, give up 15% in the, there is no magic bullet there. You just have to evaluate that as you go through those stages.
It picks up on your point, Scott, use of funds, right? It's what's the money that I'm taking in, the capital I'm taking in now going to enable me to do that's going to unlock that next round, and what do those hurdles look like? And then, obviously we want the valuation to reflect that.
Beyond valuation, Richard, there's another thing I think that at the stage that an entrepreneur is taking capital, they need to be very clear in their mind on. As you go along that continuum of capital that I described earlier, from, say, friends and family to public market investing, I think the earlier you are on that continuum, the more an entrepreneur can expect to be in a business relationship with their investors, right? Angel investing is not a transactional business for most people. Angel investors have a vested interest in what their money is doing with that entrepreneur, and they expect to be involved probably a lot more heavily than an entrepreneur, unless they've been experienced with angel investors, is used to, right? You invest in the public markets, I don't expect to call up the CEO of a company and find out what they're doing with my money. I do at the angel stage. So that transactional nature of investing gets greater as you go up the continuum of capital, but it's very hands-on and very non-transactional at the early stage. So the entrepreneur taking capital needs to expect that they are bringing on a business partner with them. And then that business partner is going to be on their side of the table negotiating the next round of capital. And as you look at that hurdle, now you're with someone, and you have to be careful about the people that you're working with as business partners, right?
Yeah, makes sense.
So I have 2 points I think that might be relevant. One is, if I'm a founder, an entrepreneur, and I'm raising capital, one thing I want to think about is what value can this investor add to my business beyond the check that they're going to write? Can they help me access more investors? Can they help me think about how to structure a subsequent financing? Can they help me find a customer? Can they help me find someone to augment my management team? So I think founders and entrepreneurs should think about value added by the investor beyond invested capital. And that's why when I said earlier, I made reference to high value angels. High value add angels. Angels that are really capable, experienced, have great networks, and a lot of capacity to add value to the business, they are more attractive to the business than someone who's going to write a $25,000 check and not be able to add any other value. $25,000 has value. $25,000 plus track record and experience and network has lots of value. So as a founder, I want to think about that. And another thing I want to think about is I don't want to raise money from this angel in a way that inhibits my ability to raise more money. Yes, I want this angel to realize a return on his or her investment, and that's important. But I don't want to raise money. If I find someone who will invest in my business, saying I'm worth $50 million, wow, great for me. I just raised money at a $50 million valuation. But guess what? The next investor might not agree with that. And if this current investor thinks I was worth $50 million when he or she invested, it might make it hard for me to raise money the next time. So I need to be thinking about my next fundraising round as I'm raising money right now.
One quick point to that. You've got to be realistic as a founder in order to raise angel capital appropriately. Because if you go out with hey, I think my business is worth $5 million and you hadn't sold the first thing yet, you're not realistic, and you probably won't even get into a conversation with that angel investor. So you have to be realistic. You have to look at the market, see what valuations are for your type of business at that stage, and understand how to engage with that person without turning them off.
Well, that's all great, great insight. And so what I'd love to do now with the remaining moments is just bring it home a little bit. Maybe each of you could talk about companies you've invested in to the extent you can. If there's deals in process, obviously those are going to be a little less able to speak about. But if you could just mention a company or two that you've invested in at the angel stage or at the early stage here in the Knoxville area, or I'd just say within the state of Tennessee.
Well, you're going to hear in a few minutes from someone we invested in earlier with, he's not surprised there, local company, Arcus Biosciences. And what I want to point out about our investment in Arcus, and I was principally involved in helping our investors do the diligence on that project. And I sat with as the shareholder representative through the meetings with the company and understood where they were going. But human beings, and I mean all human beings, we respond to stories, right? And we certainly respond to data, but data standing by itself doesn't generally convince people. And it certainly, I don't think, convinces angel investors. A good business story, I don't mean a fairy tale, but I mean a good business story, captures our attention, is memorable, and compels us to look deeper at the investment opportunity to see whether or not we want to invest. And I think Arcus did a great job, not just of having an innovative technology and the right people in place to commercialize that technology, but they told a very compelling story for angel investors. And so we were pleased to invest in them.
I'm sure they told that story concisely, Scott, right? Within a minute or so, if they've got a handle on it?
Yeah, I'll add to that. Lighthouse Fund was invested in Arcus as well. And I think that was a great example of people around the region coming together and investing in that company at an earlier stage. But then also institutional capital bringing a lot of value, not just in money, as well. And I think that made a huge difference in Arcus. I've also been engaged in another thing that I'll throw out there for angels. Over the last 5 years, I've been investing a lot of time into startups and not just money. I have invested some money, but also time. One of those is in Smart RIA. And that's another way that angels can get engaged in giving, if they've got the time. Usually that's usually small companies can't pay for the time of someone who has experience. And that's another great way to invest, not just dollars, but time into a company.
Also get a look up close, and maybe later on you write a check, but certainly the value comes either in time or money or both. Right. So.
I'll mention too, and obviously Arcus is a recent excellent success story, but as evidence of the fact that angel investing has been happening in Knoxville for a long time. This isn't something somebody just thought about recently and said, oh, hey, let's start angel investing in Knoxville. There are two companies we invested in back in 2006. One was called Eon Streams, which was right down here on the corner of Market Square. Very successful. We were the only institutional investor in that company. All of the money invested in that company was invested by angels, 90% of which were Knoxville angels. There was one guy from North Carolina, but all of that money was raised locally. That was a very, that company we invested $725,000. That company distributed $64 million to shareholders when it was sold, and one of the angels made 22 times his original investment in that company. So we invested in 2006. Another company, Protein Discovery, started by a UT MBA student using technology licensed out of Oak Ridge National Laboratory. They were located right over on Gay Street in the Phoenix building. All the first money in that company was angel money. And then there was a venture fund in Memphis, and then we invested, and then a venture fund from Texas invested. That company is an example of how local capital kept a company local. That company didn't move away because it raised local capital, and it was then able to attract more capital. So the majority of the capital that went into that business came from outside of Knoxville, but the first capital that went in was from Knoxville, and that's why that company stayed here. Until, by the way, eventually it was acquired and it was taken away. It was pulled out to the West Coast. But for the first 12 years of its evolution, it was here, and it was here because of local angels. So angel investing, this isn't new. It's not new to Knoxville. There have been plenty of successful angel investors in Knoxville. I think we just need more of it.
Well, we have 7 or 8 minutes, maybe a couple minutes each with a question. I'm going to call an audible here and ask. One of the things I wrote about in the paper that Jim mentioned last year is that, well, let me step back. At the onset of the pandemic, the knee-jerk reaction of the investor community was that there was probably going to be a slowdown in deal flow, particularly at the angel stage. And my recollection is that year on year, it was in the mid-2000s in terms of total deals closed. This is according to PitchBook. And I don't recall the amount of money put to work, but it had to be at or more in terms of just total deal, total capital that was invested. And so when you hear something like that, and obviously this is among the different efforts we're doing locally to grow the number of angel investors in town, what do you think are the top couple of things we can do in addition to the things we're already doing that can grow the angel community here? Because it just seems like the pandemic, of the depths of it, would be the last moment you'd think there'd be an acceleration in deal flow at the angel stage. So what can you think of the top couple of things that we're not already doing that might be helpful to grow that community here in the
I think this is one of them. I think awareness is probably the biggest piece to it. But the other thing that pops to mind is networking. You may be engaged in a group or a fund or something from an angel perspective. You may know more people who are not angel investors that could be, and bringing those people to the table can, I think, help significantly.
Thank you.
I think we're doing a lot of things right here, and I'm very pleased. I've been in the community a while, and I can see the progress that's been made. I can see the work Jim and his team at the KEC has put in. And I agree that events like this are very helpful. One of the things, Richard, that we saw coming out of the pandemic or during the pandemic, and our investors were no different than investors in other parts of the country. The initial news hit, many of them thought that there was going to be a slowdown or even a hiatus in investing. And then after a few months, that turned out to not really be their biggest concern, right? Good deals were still happening. So by the summer, they were still interested in going full force, although they were meeting on Zoom, not in person. But one of the things that you'll look at the industry statistics and know is that although last year was a record year for venture capital and early stage venture capital, the deals that were being done were larger, so more money was being concentrated perhaps into a fewer deals in particular industry. Yeah, big check sizes around the deals that were being made. And so I think the thing that entrepreneurs have to focus on is understanding, even in a smaller market like Knoxville, that they are in a very competitive space. And rather than assume that in a smaller city there's going to be easier pickings with investors maybe, I think they have to redouble their efforts to create very solid investable businesses. And when I mean investable, if they're not certain that their business plan is good, if they're not certain that the financials speak for themselves, turn to somebody like Jim at the KEC and his staff. And if Jim can't help them, he'll direct you to where they can get resources. But by all means, before you actually go out and pitch for the money, make sure your business is as buttoned down as possible because it's very competitive. But on the other hand, bigger checks are being written.
I think that's fair.
I'm going to piggyback on what John said about networking and communication. I think we need communication. We need to communicate about success stories, right? When there is a successful outcome, we need to make sure we tell that story because success breeds success. And if someone believes they can be successful as an angel investor, they're more likely to be active. And I think part of that communication is also deal flow. If I, as an angel investor, I'm going to invest in the most compelling company in my neighborhood, well, then my likelihood of success is not as great as if I'm investing in the most compelling company in my town or the most compelling company in my half of the state or something like that. So I think We need to communicate about success stories, make sure that would-be angels know about successes and the fact that people are making money as angel investors, and then communicate about the deals that are in the market, that could be accessible, so that the people who want to write checks and want to be active angels are getting access to the deals that have the potential to generate a positive return and sort of snowball that.
I think those are all great comments, and I want to make sure we don't leave out any of the folks who might have made a question, given us a question in the chat. 5. Okay. All right. Any areas that you wanted to expand on? We actually have 2 or 3 more minutes. Call another audible if need be.
So I think angel investing, this concept of networking, I think, is absolutely important. But one thing that, as we were talking, I don't think we hit on was, don't be afraid of it. The more you know, the better you'll be as an angel investor. And so don't think that you've just got to take what the entrepreneur says. Think of it as a negotiation about your investment, and learn as much as you can about the market, about the product or technology, and about the entrepreneur and the management team that's running the business. That's the most critical thing in investing in a business, because if they don't have a plan, they're probably not going to get anywhere. But you're investing more in them than you are in their technology and or the market that they may be engaged in. It's the people who are going to make it happen, and that's what you have to concentrate on.
Our most successful angel investors in the Appalachian region are not focused on finding the next Facebook in their neighborhood. They're looking at high-tech growth companies, they're looking at advanced manufacturing companies, but they're also looking at Main Street opportunities. And so we advocate that investors in our region should adopt a model of what we call blended investing. If you can find a good cash-flowing business in an industry that doesn't have high-tech appeal to it, but it's a good business, there's no reason that business doesn't merit angel investment, just the way perhaps a higher risk, high growth opportunity would. Make a blended portfolio as an angel investor, and you're likely to see a good set of returns.
Thank you for that, Scott. And I'll just close by saying this. You never want to time the market, public or private, but we know that we're entering a rising interest rate environment, and these assets, these risk assets are getting re-rated. They're actually, the multiples are contracting. And so from an investment standpoint, when you look at the cycle, it's not a bad time to consider angel investing if it's something that's actionable for you with the right amount of risk capital vis-a-vis your entire personal balance sheet. Again, we don't try to time markets, public or private. I had a previous life closer to the public equity arena, but it might be a reasonably prudent time to be looking at the cost, the entry multiples on some of these companies right now. Nothing, of course, trumps team, market, and the quality of the business, as the gentlemen have shared with us. So, quick round of applause for our panelists. Thank you for that. And I think Jim's about to give me the hook.
First of all, Richard, thank you for moderating that too. We really appreciate it. And let me add my thanks to all of the panel for sharing your insights and your experience here. I think it's been a really important thing for people to hear. And Grady, I particularly appreciate you bringing up the fact that we have had successful angel investors here, right? And that Knoxville is not a place that it has not worked before. But I do think, and Richard's mentioned this a few times, that cycle has been disrupted a little bit here. And part of what I think we're trying to do is make sure that continues and that it gets started again in a meaningful way for the great companies that we have here. So thank you guys again for that. John's going to stay up here because he's going to be the moderator of our next panel. And I don't know if you want to just use the handhelds or do you want to lab him up? Okay, cool. And so our next panel is actually two founders of companies who have also received angel funds and then later became angel investors themselves. And I think this is a really important pair of voices to hear for two reasons. The first is that they have seen angel investing from both sides of the deal. And I think that's a really a unique perspective and also one that's very important to this conversation. The second is something that I was just mentioning a minute ago. In a lot of communities, most of the angels are actually former business owners. They are former founders of companies. They're people who have been successful entrepreneurs and then who are looking for new opportunities to invest. And I think that's really what we're trying to encourage here, is that people who have had that experience make exceptional investors in new companies. So it's my pleasure to welcome Chad and Samer up to the stage. Samer Saab is the SVP of Product at the Alloy Labs Alliance, a consortium of 60 regional and community banks. In this role, he leads bank digital transformation initiatives centered around product and partnership development with startups. Samer is also a venture capital investor via the Alloy Labs Alchemist Fund and is the head of the Concept Lab Accelerator. He also angel invests typically in the fintech and crypto spaces. Samer has founded multiple companies raising from angels and VCs on 3 continents. Thank you for being here. We appreciate it. Chad Seaver is the CEO of Scintillite, a medical device spin-out of Seattle-based Intellectual Ventures. He previously co-founded and CEO'd Arcus Biosciences, a Knoxville-based medical technology company. In July 2019, Arcus was acquired by Integra Life Sciences, a global medtech conglomerate based out of New Jersey. Chad additionally serves as commercialization advisor through Prometheus Biomedical Solutions and is an impact investor supporting med and biotech startups. A Kingsport native, he has a master's in electrical engineering and a PhD in biomedical engineering from the University of Tennessee. And John, I will turn it over to you.
Great, thanks, Jim. So let's start off by telling people about the company first to get a baseline. Tell us what it was, what was unique about it, or is unique about it before we get into angel investing. Samer, go ahead.
Yeah, so I've started 2 companies that have received angel investing and venture capital investing as well. The first was in the product design space, and the concept that we had developed was a crowdsourced product innovation platform where we worked with large product manufacturers who set out challenges for us to be able to push to the global community of independent product designers. So we were able to tap the long tail of product innovation that was available by accessing this community that we had fostered, and then trying to actually create real physical products coming from that. The other company that I had founded in partnership with my now wife, Trisha Martinez, is called Walla. Walla was a digital financial platform to serve the major unbanked and underbanked problem, particularly in emerging markets. So we were headquartered in Cape Town, South Africa. That's where the base of our operations were, serving the entire southern and eastern regions of the continent. The product was a neobank style solution built atop the blockchain. And the one interesting thing that I will note about both those products and those companies was that over the course of the lifetime of running both of those, the products that we were actually building and the purpose of the company, though the mission had sort of remained the same, the products evolved greatly. And it's particularly important because I think that's something we'll touch on as we get into the role of angels and helping to support that.
So I'm a co-founder of Arcus Biosciences, as you know, and it was a medical device company co-founded in 2011. I had 2 other partners with Arcus Biosciences in the beginning that are co-founders, and we were a company addressing needs in neurosurgery to make neurosurgery less invasive through innovative guidewire technology, but we also in-licensed technology for catheters as well that make catheters less prone to obstruction. And we received angel investments early on in the company that bootstrapped the company, essentially. And we introduced the products, a portfolio of products in 2016, and then over the course of several successful growing years, we attracted interest from a variety of strategics, and it ultimately led to the sale of the company. We found that it was the right time to take a transaction on the company in the summer of 2019.
Okay, great. Well, two very different ideas and technologies. Chad, while you have the microphone, so answer this about angel investing. How did you get engaged with them? At what stage did they invest? And what did you use those funds for?
Sure. So the original angel investors in Arcus Biosciences were former colleagues of mine who were successful entrepreneurs themselves. So it kind of follows on the theme that the previous panel was discussing. Oftentimes, angel investors are entrepreneurs themselves, and so they understood the medical device space and essentially invested at the seed stage of our company. And this was a critical time period. And at that point, we essentially began operations. So like I say, they bootstrapped the company with the first angel investments that helped us undertake research and development to get to a minimally viable product.
Okay. All right. Samir.
So how did we find angels? So how do we go about finding angels first? It's a lot of hustle. So you talked about networking a lot. It is a lot of networking. It's about being where angels are. It's about being where entrepreneurs are. It's about generating interest for your company that allows you to be more present in conversations where angels might be. But it really is about you hitting the ground and doing the work, getting in front of as many people as possible. Sometimes it is friends and family if you are so fortunate to be able to use that as a starting point. But even if you have only one friend or one family member that will invest, you still have to, and they have a network that you can tap into, you still have to hit the ground and do all the work there. What we use the money for, the way I think about investing in startups in general is that there's two phases of what you're investing in the startup. You're either investing when they're at the growth phase, or you're investing where they're in search of product market fit. And so everything before the point where you're just ready to add fuel to the fire and grow like crazy is to help in the search of product market fit. And that is where you are going to continue to iterate. That's where your business model might change. It's where your product might change, or your entire company. Your branding might change. We rebranded Walla probably 3 times. Once because we received a cease and desist from the global money switch Swift. So all of those things, it's that messy period, and the more that you progress as a company, the more it's easier for venture capital or private equity or late stage funds to step in and fill and just inject large amounts of capital. And that earlier stage where you're really searching, and I like that sort of concept of searching for product market fit, is where angels can really fill those gaps.
Okay. So let me turn this just a little bit. If you were to give advice to a potential angel investor who had never done that before, where would you tell them to start?
I would pretty much give the same advice that I would give to an entrepreneur. Go to where the entrepreneurs or the investors are. Because as the last panel talked about, you have to network yourself. But the only way to network is to start by figuring out where those individuals might be. If you're looking for entrepreneurs, then you can go directly to those. If only there was a entrepreneurial center here in Knoxville where someone could go get involved. Hence where we are. Or go to investors, and they don't have to be other angels. If you can find the funds that might be primed to invest after an angel might. So a venture capital fund, and saying, I'm interested in being an angel. Are you getting deals, or do you know angel networks? These are opportunities for you to make your presence known, so that as interesting things do come about, you're at least top of mind for those referrals.
Yeah, John, I would highly recommend that prospective angel investors get involved with an angel club or an angel fund, because you're going to be surrounded by like-minded investors, many of those experienced. Furthermore, they're going to be acquainted with the current valuations that are involved in companies in a particular sector, the investment structures, whether those might be through convertible notes or private placement memorandums. So I think that there's comfort to be found, as well as deal flow through angel clubs, to be able to get exposure to viable companies coming to pitch. And a few minutes ago, I mentioned that my initial contacts with angels into Arcus Biosciences was with previous relationships, but we had angel investments that followed on into various stages of the company, including the Series A and a growth stage that we had. And so those came about by just really looking for the investment venues, the events to where an entrepreneur could apply to be able to present. And we were fortunate to get a number of those spots here within the region, but as well, I pitched coast to coast, from the Northeast, and we brought in investors from the Northeast as well into the company. And so first, I would recommend an angel club to get involved with that. Secondly, you can encounter deal flow through advisors of startup companies or investment bankers, for instance. But I think it's good to have colleagues that are also making investments as well to kind of sound out that logic of the reasoning behind making the investment.
Yeah. So another sort of pivot question, if you will, this one's two-parter. How critical is angel investing to startups? And then the second part of the question is, how critical is angel investing to the local entrepreneurial ecosystem?
Shall I go ahead and, well, I think it's essential. Arcus Biosciences, without the angel investing that bootstrapped the company through the seed stage, Arcus would have never been a success story that we'd be sitting here talking about. Certainly, I had been looking for funding prior to encountering those angel investors, and we did have some opportunity, but it wasn't so attractive. It was through some grant funds that I'm not sure was a great fit for us. The alternatives for early stage financing are usually through grant mechanisms. The SBIR program, I think, is touted as the great, seed financing in the United States anyway. And so the alternatives are grant agencies. I suppose if a company's already, has revenue, they might be able to go to more traditional financing avenues. But in my mind, long story short, it's essential because it takes companies that have a concept and there's a good team there for angels to be able to come in and partner with an early stage company, to partner with them. And that's the way that the entrepreneur should view it, as well as the investor. And so in terms of the ecosystem, I think that it just follows on that, to grow a garden, you have to start with a plant and you have to nourish it, and, it fosters the entire environment. Yeah.
Yeah, he's absolutely right. Early stage startups are messy. There's so much that goes wrong multiple times a day. You feel like everything is catastrophic by lunch and euphoric by your afternoon coffee. And that's every day. The more a company survives and advances, the more they have access to invest to venture capital and more professional funds. But the more they progress, the more they encounter funds with more rigid bounds on what they're able to invest in. So angels play a particularly important part filling those gaps early on where, like I said, it's messy, it's tough. You're not as bounded by the mandates that have been set by a fund's LPs. So the angels can be the first money in that just believes in the founder, the first money in that believes in the opportunity, that thinks it might be crazy, but you still want to back them. The angel can be the easier source of capital that can provide that bridge to get to survive one more month and get to metrics to put you in position to, close that customer or get that next round of funding, whatever it might be. And those are critical points in the startup's journey, because the reality is that no matter how fast a startup achieves success, it's never actually an overnight. Like there are, I think about Slack, now no longer a public company because they were bought by Salesforce for $27 billion or something. But when they launched, they were this massive overnight success. Like they raised 2 rounds back to back at like hundreds of millions of dollars and $1 billion valuation, like overnight, just crazy growth. But no one had seen the work they had done for the previous 2 years in building that, or had even realized the fact that they were actually a gaming company that turned into a chat company. Like there is no business plan that starts out and says, yeah, we're going to become this massive messaging company out of a game. Like that just doesn't happen. And so you need the angels to really help and encourage and be open to those opportunities. And then for an ecosystem perspective, like the same sort of thing. If you want big companies to be able to flourish here, you need to have the investors that are willing to support those companies and struggle through those, and also forgive entrepreneurs that just can't find it and generate those positive outcomes. We can't punish entrepreneurs that give their all and struggle through, but still just can't make it, because entrepreneurship is actually really hard, especially if you're trying to build a really big, impactful company.
This is, I know both of you are angel investors as well. So what would you, what made you decide to do that, and why do you think others should get involved and become an angel investor?
I think for me personally, I've sort of just fallen into angel investing. I think it's more just a result of the work that I do on a day-to-day basis, because I'm around startups a lot, both with my work with banks and then trying to help them. And because I just love being around startups and dealing with that early stage discovery or finding the product market fit or getting to that escape velocity. And then also being able to contribute value beyond just the dollar amounts that we're able to invest. There's a reward having been on the other side of that and knowing how difficult it is, and being able to help entrepreneurs get through that and achieve that success that I enjoy and I want to be around. I also love angel investing because there's so much creativity in starting a business. It's not just using a novel technology. It's not just finding a really unique problem or a difficult problem, but coming up with interesting solutions. And that creativity is just, like for someone who's intellectually curious, can get a lot of enjoyment out of that. So I just enjoy being around it and see what's happening. And then when I can add value, that's great.
So as much for the money that you invest, but the journey of the investing as well.
Yeah, I mean, I'm an entrepreneur. I will probably do more entrepreneurial things again in the future, and I enjoy being around entrepreneurs. And so it just allows me to do so.
Chad?
Yeah, sure. I mean, for me, it really boils down to two things. It's the impact. I'm very passionate about having an impact in healthcare through med tech or biotech. To be able to make a direct investment in a company that is well positioned, has a great team that I have faith in, to be able to go out and have a probability of innovating in the space and improving healthcare for all. That's the real deal for me, is that passion. Secondly, the return on investment. You know, it's a very lucrative opportunity to, on the average, exceed, you know, more late stage, less risky types of returns. And so the return on investment that can be attained, you know, as many of you know here in the audience, you know, through angel investing, it's very attractive, you know, to take a portion of your portfolio and invest in a company that you believe in, you know. And, you know, like you described, to go along with the journey and contribute where it makes sense. Mm-hmm.
Yeah, that portion of the portfolio is a great point that I don't think we've talked about. You know, angel investing is not everything you've saved into one company. That is not what angel investing is. Angel investing is taking a portion of your assets and investing in that company. But I think also there is a lot of satisfaction. Even those companies that don't succeed or return to those investors, sometimes there is a lot of learning that goes on for the entrepreneur, for the investor, but also that learning can churn just as much as money can churn back into the environment and the ecosystem, so people can actually know what not to do the next time, right? Yeah. Go ahead, Samir.
Right. You know, if you invest in a startup and it fails, but you went through a journey with that founder and would be excited to invest in them again, that's still a positive outcome, because that person has grown through that experience and has they have de-risked themselves in terms of being an entrepreneur that you can invest in and have a higher degree of confidence that they're going to be successful on their next one as well. So there are, even in failures, there are opportunities for value, because you have that relationship with that founder. They've learned, you've learned, and then you now have a relationship that might make it so that you would be ready to step up and invest in their next company. And that could be the one that hits.
Yeah. So one other question that came from our audience last time, and we've talked a little bit about this in both panels, and that is this thing about investing advice as well as money. So how would you recommend to an angel investor that they balance those two between advising the company and investing in the company?
I would separate them out. And make clear when you're talking to the entrepreneur from the start which one you would be interested in doing. If you're only interested in advising and there are some financial terms or some equity terms that are associated with that, make that clear. If you're looking to invest and you also want to commit time to the entrepreneur, make sure that that's clear as well, because they might just be looking for someone that is going to be a check, or and if that's the case, then it might not be a fit. So I don't think there is a right or wrong answer in whichever you want to do, and because it's a landscape. And some investments you may just choose that you do want to provide advice because that's where you have some expertise, or you may want to provide advice on certain elements of the business. Like, for instance, if you're excellent at partnerships, or if you have connections in certain funding circles, then like that's where the entrepreneur might tap you for advice. Whatever it is, just be clear with the founder or the entrepreneur up front on what your expectations are and what type of relationship you hope to have.
From my viewpoint, if I'm making an investment into an early stage company as an angel investor, I'm largely investing into the team, because, you know, as much as he's described, and having lived the life myself in Arcus Biosciences, a lot of the investment, from my viewpoint, is into the team, for their ability to be able to pivot, to adjust, you know, for all the reasons that he described. There's a lot of challenges in startups. New things come about, markets change, new competitors come in, things fail. I mean, there's just a variety of things to overcome. Making an investment in the right team or a team builder to put a team together to be able to address those things is first and foremost to me. So the concept of advising along with investing is not something that I would be thinking about so much. Obviously, I want to think about how can I contribute to the company something more than just a check. But at the same time, I'm not going to provide a check unless I believe that the team is there or the team builder to be able to pull it off. I'm happy to complement that and make myself available as much as practical to the company. And they're certainly welcome to ask me to advise them, make introductions, whatever it is that I can do to help them be successful. Like I say, it's a partnership. It's a partnership. So I'm their partner, but at the same time, startup teams are notoriously strapped. They're working very long hours just to try to pull things off, and I don't want to be a hindrance to the team if I'm not needed. So I want my investment to be most efficiently utilized, and if that's me assisting and providing some advice to them, then I'm more than happy to do so. I'm a vested partner in the company. But if not, then I'm hands off. Let them run with it. That's why I invested in them. Mm-hmm.
Yeah, so I think that's a great point, because the absolute worst thing you can do as an angel investor is to invest and think that gives you the right to tell them what to do, right? That's the recipe for disaster. So advice is one thing, but instruction is another thing. So you want to make sure that as an angel investor, you're giving advice when it's asked for, when it's maybe needed, but not constantly in the face, not always telling people what to do. I had a situation years ago in a startup where I had an investor from Southern California, and right after the papers were signed, he called me and said, "I think we should sell these things in Argentina." And I was like, we can't even make them in the U.S. yet. Let's don't go to Argentina. So I think you have to make sure you're balancing that, and investing in the team is absolutely critical. Absolutely critical. Do we have any other questions from anyone?
Yes, there is a question directed
Okay.
to Chad. Sandra can help with this. In the chat it says, as an angel investor, what metrics do you consider for startups, small businesses in early stages that are not profit, since they are usually not making money yet?
Well, good question, and it's a complicated question because it depends upon the business. But if I'm investing in a tech business that I'm accustomed to, that's an industry I typically invest in. So I'm just throwing out a caveat. It depends upon the company and the landscape of what you're looking at. But if I'm investing in a med tech or biotech company, first and foremost, I'm looking at the intellectual property scene. I'm looking for what patents have been applied for, either through a provisional or non-provisional. What is the international applicability of those patent applications? What examination? What have been the examination results of those if they're not already issued? I'm really digging into the intellectual property, because if a very smart company develops a product or a service that they can't protect, then my money that's going in as an angel investor is just fueling an opportunity for a larger, more resourceful company to later see a product or service get validated, and then only for them to copy it. And sometimes that happens anyway, even with the intellectual property. But at least with the intellectual property, there's a chip in the game for being able to either pursue the companies, or better yet, partnering with another strategic competitive in the landscape to pursue the aggressor. So the intellectual property is very important to me. I think, like the previous panel discussed, if there has been previous money into the company, what has the startup team gained from that investment? I know as an entrepreneur myself, for any, I'm always telling my team, whatever dollar we spend, I want you to be thinking about getting $10 back on it. And of course, that's not practical for everything, but that's the mindset. It's $10 for every buck we put into this, every buck that we spend. So, I want to see progress on what they've done in the past that are clear value milestones, whether that be in product development, of demonstratable, product on the bench, or customer feedback, intellectual property steps. Those are the things that I'm looking for in the earlier stages of a med tech or a biotech company.
That's great, because I take a completely different approach because we don't invest in the same space. So most early stage startup decks follow the same playbook, like it's problem, solution, here's our unique business model, here's our addressable market. Like they're all pretty much the same. So the things that I care about are in thinking about all those components. So like, who is the customer? What is the problem that they're feeling? What is your unique solution? Why is it unique? What do you know that other people don't know, either about the market or about the way that you're building this? What do you think about your unit economics, which are essentially how much is it going to cost for you to acquire a customer, and then how valuable is that customer to the business, both in the short term, so how quickly do we get paid back on it, and in the long term? And then, did I say addressable market? How big is this market? How large can you be? Can you actually grow into this? Are there competitors that own this space? And do you have a vision for where this can go? So all of those things are essentially the basics of early stage startup investing. The thing of early stage startups, the way that I like to think about and approach it is not do I believe what you're putting out there, because most anything that an early stage entrepreneur is putting out is baloney. Most of the time it's just guesses. So the better way to think about it is, how confident am I that each one of these components have been sufficiently de-risked? And so how much evidence is there actually that they have identified a really important problem, and that they're solving the problem for the right customer who is willing to pay and that needs this exact solution, and that they have a strategy for how they're going to grow this efficiently and then capture this big market. All of those are just the sort of basics. It's super simple math, which is why venture capital is so funny, because it just often comes down to a few metrics. But where it becomes difficult to be a good investor is how much confidence do we have that they've actually de-risked a lot of these things? Sometimes you have to take a leap of faith. Sometimes the leap of faith is driven by the fact that you just absolutely love the founders, or you think that this needs to exist, and so I'm going to put some money behind them and help them get some runway to figure it out. But taking your own approach to having a risk-based investment strategy that accounts for whichever metrics or components matter to you is how I think you get your own investment strategy.
Well, thank both of you for coming up here and being here. Certainly look forward to all the things you're going to do in the future. Thank you.
For you and Grady and
Okay, sure. Or Richard. Richard was going to do that. I'll let Richard come up and do his job. Come up and get his pay.
Hi, folks. So the mic is still good? Okay. All right, well, thank you. Thank you.
there
Oh,
are 2 questions in the
from the chat. Okay, great.
Towards the experts. The first one is, what kind of capital do you recommend starting with? I've been writing $10,000 to $20,000 in checks, and I am beginning to explore writing larger ones. Should I consider joining a fund or setting up a cap for myself?
I would not, well, it's hard to say because I don't know the situation. If you've invested money already and you're looking to invest bigger money, I would look for someone else to come alongside me to validate my own investment. I wouldn't chase with my own money. I would look to find someone else who could, we call it validation, but it's really somebody else who'll come in and look at it and go, oh yeah, I'll come along with you to do that. I think that is the best way to make sure that you're not going off in, down a rabbit hole.
Yeah, and again, I don't know the situation, so I can't speak in specifics. But part of having someone to validate or people to validate your decisions alongside of you, I think is a benefit to being in a group or a fund. Another benefit is if you're writing $10,000 checks, and you're following any kind of a portfolio allocation or theory, right? Diversifying your portfolio. That would imply that you're probably working with a portfolio or enough money that you could put, say, 20 or more investments together at $10,000 each, right, in order to get adequate diversification. Because study after study have proven that in early stage or angel investing, just like other types of investing, spreading your, let's say, bets over a number of companies, and that number seems to be in excess of 20, reduces your risk in the portfolio overall. So if you can individually put together a large portfolio like that, great, but sometimes belonging to a group or fund where you're making perhaps a smaller contribution into a larger pool is a way to achieve that diversification.
I don't know that I have really much to add to that. I think there's something to be said for leveraging resources and groupthink. One person has a finite amount of bandwidth, and particularly if they have a regular career or a job and they're investing on the side, there's a finite amount of time they can put into investing. So if there are ways to leverage resources and access the thinking of other smart people to sort of multiply your investment capability, then I think that's a good thing.
The other question is, how long should I spend on diligence? Is there a top 5? Are there a top 5 factors or similar I should look out for? How do I balance speed of getting into the round versus not getting swept up in the hype?
Well, I'll start that since diligence is pretty much my life. Again, you can go to the Angel Capital Association, you can go to Kauffman Foundation, you can go to any number of resources and see that the research on this subject is pretty clear. Once you get over about 20 hours of diligence per investment, your chances of a positive investment return begin to improve dramatically. So typically, and I've used the word before, professional investors, professional angels or professional venture investors are putting in 20 to 40 hours at least of diligence time on each deal. In some cases, if it's a complicated deal, it's going to be substantially more. So there's no really quick and easy way to satisfy all the questions that need to be answered if you're looking at an early stage deal. John?
Yeah. So the way I've always heard it was, you can be so good at due diligence that you never invest a dime. And it's just a balance. You have to get enough information to be confident in the investment, but you can't wait around forever. You've got at some point to make that decision of go or no go.
I'll just make one comment. I'm a fan of, pardon me, interacting with a company or a founder or an entrepreneur over a long enough period of time that I can get a sense for if they're able to do the things that they say they're going to do, and if the things that they tell me are going to happen in the business actually happen. So, how long is due diligence? Is it 9 months or is it 20 hours, right? If I interact with somebody today and then I touch base with them again in 90 days, and in 90 days, Have I been doing 6 months of due diligence, or have I been doing 2 hours of due diligence over a 6-month period of time, which allows me to assess that business over time and not just in an instant of time. So, it depends what you're trying to find out about the business. Some things you can find out in a matter of minutes, and some things you can't find out for months. And I'd rather know it before my money goes in than after my money goes in, to the extent possible.
Yeah, and I'll add, just because it was the last part of that person's question, are there a few things that are very important in diligence, the key elements? I would say one of the reasons that angels are going to spend a significant amount of time, perhaps over a long period of time, right? Dating before you marry kind of thing, getting to know an entrepreneur, is they're looking for telltales about that entrepreneur's character. And I think that's an essential thing. As an entrepreneur, you can mess up, if you will, on presenting certain facts. You may have made a mistake. There are things that can be explained away or corrected. But if an investor has some reason to believe that you are not telling them the truth, or that you're perhaps, with your pro forma numbers, beginning to get, shall we say, a little bit shady, the investor will turn off on you immediately, and you won't get a second chance. So I think one of the big parts of diligence, you're asking for facts, you're asking for numbers in diligence, but you're really seeing how that entrepreneur is responding to you, and are they a character or a person that you want to have an ongoing relationship with.
Those are the questions from the chat. Great. So, audience has been super patient. Is there anyone here that would like to volley a question to the panel?
I'll shoot one. Welcome anybody in seminar and chat too. Is investing in Knoxville different from other regions? And if so, why? And what distinguishes it for? What do we need to do to improve it? We don't repeat that question too.
So the question is investing in Knoxville different than other regions or other cities? I sort of had a visceral reaction to that. You saw the way I picked the microphone up. No, it is not different. Do we have maybe less capital than Silicon Valley? Absolutely, everybody does, right? Do we have maybe some different technologies that most other cities don't have? Yes, but it is not inherently different than other places. We may have more or less of it than other regions, but the activity is the activity. Angel investing is angel investing. And what goes on in Knoxville, and has gone on, as Grady pointed out, over the years, is what's gone on in Nashville, it's what's gone on in Huntsville, it's what's gone on in Tri-Cities and Johnson City, all over the Southeast and the rest of the country. It is what it is. And in fact, I would say you could learn from looking at some other places about angel investing as much as you could here in Knoxville. So I think it's the same.
I agree with John in that, we could probably all pick up and move to Europe and find ourselves in familiar situations if we were angel investors, or to South America or to Asia. I think John's right. Investing as an activity follows some basic rules. You're taking a certain amount of risk for an amount of return, and you're trying to measure that. Investors aren't really risk takers. They're risk managers, right? So that goes everywhere. But I will say one of the things that may be a little different in our region as opposed to coastal or money center markets is the structure of deals and the type of deals that are favored here. There might be some investment vehicles which are very loosely used, say on the West Coast, which investors here may not be as comfortable with. Not that they don't know about them, but for their own reasons, they may have a particular reason not to want to do that type of deal, or the size of the deal, or how money may be tranched. Those particulars, I think, do vary somewhat regionally.
Others? Sure.
One thing that's not especially intuitive is the outcomes that are possible, and Richard, we were talking about this before, the outcomes that are possible for a company are not solely determined by the entrepreneurs and what they're building. They're also heavily influenced by who the investors are. And so if you don't have angel investors that are willing to take on a certain risk profile, then you also can expect to have certain outcomes. Silicon Valley thrives on this. That's why they continue to produce, 10, $100 billion companies, because they have angel investors that will always turn around. There's another generation. And so if you're thinking about can Knoxville be a place where we have $1 billion exits, $10 billion exits, we also need to open up for the possibility to create those as investors and not just entrepreneurs. And if you have entrepreneurs that are leaving because they want to build $1 billion or a $10 billion company, we have to also understand that the requirements that we place on entrepreneurs that are raising at earlier stage can be driving them away and then leaving us to just self-select and influence the outcomes for the companies that do stay and who we ultimately invest in the local communities. So think about the role that you as the investor plays just in terms of, or just through the way that you interact with entrepreneurs at the early stages.
Thank you for that, Samer. Others? We have a few minutes. I know some of you here. This is not a shy group, if you want to. Let me just pick up on what Samer said and say that, in my short time here, I've kind of jumped in and tried to, do what I can to expand the capital network here, and that work is ongoing. These men here have been active in the community for a long time. There's others in the audience who've been active and will continue to be, and I think we're doing the things that are going to help grow the capital network and expand the number of active investors in the region. I said this last time, and my observation just coming here from Virginia was that the DNA of entrepreneurship in Tennessee runs deep. And from every end of the state, there are some of the most important companies in the world were started here and continue to run here. And so I think we're doing some new things, but there's some existing things that we can tap into that are innate and are natural assets here in the region. But it won't happen overnight. But because here we're talking about early stage and angel, and we got to think about follow-on rounds and other stages. I think if you pick certain lanes, such as transportation, materials, and healthcare, certainly Tennessee has and continues to be pretty strong straight through the company life cycle. But we're doing more and more every day to expand those sectors where we have a more complete capital stack. And if we stay at it, I think we can revert back. So again, my observation just coming here over the last 4 years is that it's a natural extension of the assets here in the region, entrepreneurship and building great companies. So if there are no further questions, am I going to get the hook, Jim, or are you going to close us out? You're bringing us home, or I'm taking it? Because,
If there are more questions, we'll take them. Otherwise, I think I'm bringing us home.
All right.
So how about one last round of thanks for all of our panelists? Thank you guys for being here. We really appreciate all that you're doing and all the wisdom that you have shared with us. And thank you to the audience as well. We appreciate you taking time out of your day today to join us to learn a little bit more about angel investing. Hopefully some of you have been inspired. And for those of you who are here in the room, as you leave, there will be a list of local investor groups and capital providers that you're welcome to take and touch base with them if you're interested. And I believe that Nancy is putting that list in the chat as well. So anybody who's online, you should have access to it as well. Our last event in this series will be on March 22nd. Women in Angel Investing is really a combination of both of the first two events that we've done. And it will be geared primarily toward women, but anybody is welcome to join us. So we hope you'll be able to make it on the 22nd of March and hear a little bit about how women can be angel investors. Angel investing is also an important but just one of the many ways in our community that we can increase access to capital and there will be more opportunities on the horizon to learn how you can help grow our region's entrepreneurial ecosystem. So stay tuned for other upcoming events that will be focused on the same thing. Last reminder, the Marble City Angels are meeting here beginning at 6:30 and going until 8 o'clock. You are invited to stick around and join them in hearing pitches from entrepreneurs if you are interested. And for our online audience, I believe that will be in the chat as well. So you should be able to find the links to both of those there. Thank you guys again for being here. I appreciate your time. We appreciate all you're doing for this community. And I hope you have a great evening. Thanks.